While most people were distracted by year-end headlines, rate cut speculation, equity records, election noise, something far more structural shifted beneath the silver market. It didn't arrive with a spike on a price chart. It showed up in the plumbing: inventory classifications, delivery queues, lease rates, and the widening gap between paper claims and physical availability. The core event is simple to state and hard to accept. The price of silver is being set in a market where the marginal unit is no longer reliably deliverable. That sentence carries consequences. Price discovery only works when a contract represents something that can be produced, delivered, and cleared without friction. When that assumption erodes, the number on the screen becomes a signal about leverage, not about metal. The crowd misses this because screens still update. Futures still trade. ETFs still publish net asset values. The machinery looks intact, but the incentives inside that machinery have changed. January matters because it resets constraints. Refiners rebook feedstock. Manufacturers restock. Mints reopen order books. Banks refresh balance sheets. At the same time, futures markets roll large portions of open interest from front months into new contracts. That roll is not cosmetic. It determines who must deliver and who can defer. When inventories are abundant, the roll is routine. When inventories are tight, the roll becomes a negotiation between time and metal. The forcing mechanism here is a collision between financial volume and physical throughput. On one side, global silver derivatives represent billions of ounces in notional exposure. On the other, annual mine supply is roughly 800–900 million ounces, with only a fraction immediately deliverable into exchange warehouses. Even small changes in availability, tens of millions of ounces, can destabilize a system that promises instant settlement. What's at stake extends far beyond silver enthusiasts. Silver is a dual-use commodity. It is monetary and industrial. Roughly 55–60% of annual demand now comes from fabrication: solar panels, electronics, medical equipment, and power infrastructure. If the futures price underestimates scarcity, manufacturers misprice contracts, governments misread inflation pressure, and capital flows misallocate risk. A cheap silver price suppresses recycling, delays mine investment, and encourages consumption at the exact moment supply elasticity is lowest. This is why January becomes a warning. The market is being asked to clear new industrial demand growth, often estimated in the 3–6% annual range, while above ground, exchange-registered stocks have trended sideways to lower in recent years. Meanwhile, financial participation has not shrunk. Open interest still implies claims that exceed readily deliverable inventories by multiples. In calm periods, that mismatch is invisible. In tightening periods, it becomes the story. Now here's where it breaks. Futures markets assume that time can substitute for metal. Roll the contract, extend the promise, and the system stays liquid. But industrial users cannot roll a production line. Solar manufacturers cannot cash settle a wafer. At some point, a paper price that says ample collides with a factory schedule that says short. This content is for educational purposes only. It is not financial advice. Markets involve risk, including loss of capital. All numbers discussed may be estimates or scenario ranges. Consult qualified professionals before making financial decisions. To understand why silver prices can stop reflecting reality, you have to separate two markets that share a name but operate on different physics: the paper market and the physical market. The price you see on screens, in headlines, in ETFs is overwhelmingly set in the paper layer. Futures contracts on exchanges like COMEX represent promises of silver at a future date. Each standard contract is 5,000 troy ounces. When 100,000 contracts trade, that is 500 million ounces of notional exposure changing hands in hours. That volume can exceed half of global annual mine supply in a single day. Yet almost none of that metal moves. In normal conditions, fewer than 1–3% of futures contracts ever result in physical delivery. The rest are closed, rolled, or cash settled. This is not a flaw, it is the design. The futures market exists to provide hedging and price discovery, not to function as a warehouse. The problem arises when the marginal price, the price at which the next contract trades, is set by actors who never intend to touch metal, while the actors who must touch metal, fabricators, refiners, mints, are price takers. Think of it as two clocks running at different speeds. The paper clock trades in milliseconds. The physical clock moves in weeks and months. Mining, refining, shipping, assaying, vaulting. When inventories are healthy, these clocks stay synchronized. When inventories thin, the clocks drift. The key mechanical bridge between the two is the futures curve. In a well-supplied market, silver often trades in mild contango. Future prices slightly higher than spot, reflecting storage and financing costs. When metal becomes scarce, the curve can flatten or invert into backwardation, where near-term delivery is more expensive than future delivery. That inversion is a stress signal. It says, time is no longer a substitute for metal. Consider a simplified numerical example. Suppose spot silver is $24 per ounce. A 3-month futures contract trades at $24.30, implying about 1.25% annualized carry. That is normal. Now imagine physical availability tightens. A refiner needs 10 million ounces in February, not April. Spot bids rise to $25. Futures lag at $24.40 because financial sellers are still comfortable rolling. The curve compresses. Lease rates, what it costs to borrow physical silver, jump from, say, 0.5% annualized to 5 to 10%. That is not speculative demand. That is industrial urgency. But the headline price remains anchored to futures volume. High-frequency traders, macro funds, and market makers dominate turnover. Their models respond to rates, dollar strength, and cross-asset volatility. If real yields rise 50 basis points, algorithms sell silver regardless of warehouse queues. The screen price reflects macro correlations, not pallet counts. This is the structural blind spot. A solar manufacturer does not hedge 18 months of feedstock at once. They buy in tranches, often months ahead. If the futures market says silver is cheap, procurement stretches. When delivery windows tighten, they all rush together. The futures market, designed to absorb speculative flow, suddenly faces non-negotiable demand. That demand is small in contract count, but absolute in physical terms. Now here's the part most people miss. Exchanges manage this tension with classification. Warehouses report eligible and registered stocks. Eligible silver meets purity standards, but is not committed for delivery. Registered is attached to a warrant and ready to be delivered against a contract. In stress periods, metal can move between categories without a single ounce entering or leaving the vault. On paper, supply appears stable. In reality, the float shrinks. If open interest implies claims on, say, 800 million ounces, and registered stocks are 100, 120 million ounces, the system relies on most participants never asking for metal. That works until a subset must. When even 5-10% of longs prefer delivery, the ratio becomes unstable. The futures price can therefore remain calm while the physical market fractures. Premiums on coins and bars rise. Delivery times extend from days to weeks. Lease rates spike. These are not emotional signals. They are mechanical. Every market stress event eventually reveals who is flexible and who is trapped. In the silver ecosystem, flexibility belongs to financial actors. Funds can close positions. Banks can roll exposure. Market makers can widen spreads and step back. Industrial users do not have that luxury. A semiconductor fab, a solar panel manufacturer, or a medical equipment supplier cannot roll a production line. Metal is not a portfolio position. It is an input. When it is missing, output stops. That asymmetry defines the pressure points. On one side are entities that treat silver as inventory: refiners, mints, fabricators, and exporters. Their incentive is continuity. A factory losing 1 week of output may forfeit contracts measured in tens or hundreds of millions of dollars. On the other side are entities that treat silver as exposure: hedge funds, proprietary trading desks, ETF arbitrageurs, and structured product issuers. Their incentive is liquidity and basis management. They can substitute time, cash, or alternative instruments. Between them sit banks and exchanges, whose role is to keep the bridge intact. When the physical market tightens, the first visible stress often appears in the lease market. Lease rates are the price of borrowing metal, typically quoted annualized. In calm periods, silver lease rates may hover below 1%. In stressed periods, they can jump into the high single digits or low double digits. That change is not sentiment. It reflects a real scarcity of lendable ounces. Now imagine a manufacturer that requires 2 million ounces per month. At $24 per ounce, that is a $48 million input. If lease rates rise from 1% to 8%, the financing cost on borrowed metal jumps by roughly $280,000 per year. That is manageable. But if the manufacturer cannot borrow at any rate because counterparties refuse to part with inventory, the cost is not financial, it is existential. Either metal is sourced at a premium in the spot market or production halts. This is where behavior becomes binary. Either physical users bid above futures to secure supply, or Paper holders are persuaded, through price or policy, to release metal. There is no third option that preserves both low prices and high throughput. Who else becomes trapped? Short sellers in the futures market. In normal times, being short silver is a financial position. Losses are marked to market and can be managed with capital. In a tight physical environment, a short who is assigned delivery faces a different constraint. Metal must be sourced. If registered stocks are thin, that sourcing competes directly with industrial demand. The cost is not the futures price, it is the replacement price in a stressed spot market. Banks face a different trap. They intermediate between paper and physical, they finance inventory, clear trades, and issue structured products linked to metals. Their models assume that futures liquidity is a reliable proxy for physical liquidity. When that assumption weakens, balance sheets are exposed. A bank that hedges client exposure with futures may discover that closing a hedge moves the market more than expected. Liquidity becomes procyclical. It vanishes precisely when needed. Governments and central banks also enter the frame indirectly. Silver is not a reserve asset like gold, but it is embedded in energy transition policy. Photovoltaic installations now consume over 150 million ounces per year in some estimates. A 20% disruption in that flow delays gigawatts of capacity. That becomes a policy problem. Subsidies assume material availability. Shortages translate into higher project costs and slower deployment. Historically, this pattern is not new. In 2020, during the early pandemic shock, silver futures collapsed while physical premiums exploded. Retail coins traded 20–40% above spot. Mints shut down. Refineries slowed. The futures market cleared. The physical market broke. The difference today is scale and persistence. Industrial demand is structurally higher, not cyclically spiking. Solar capacity additions are measured in hundreds of gigawatts over a decade, not in a single stimulus cycle. What's similar is the mechanism. A paper market pricing abstraction collides with a physical system bound by throughput. What's different is that the abstraction is now larger relative to the float. This is the part most people miss. The crisis does not begin with a price spike. It begins with a queue, a delayed shipment, a lease desk that says, we can't source that size, a mint that posts out of stock despite a stable chart. These are not anecdotes. They are early indicators of a regime shift. To understand why normal silver pricing can fail, you have to reduce the story to flow math. Not sentiment, not charts, flow. How many ounces are produced? How many are consumed? How many are available for immediate delivery? And how many are promised on paper? Start with supply. Global mine production in recent years has hovered in a broad range around 800–900 million ounces annually. That number sounds large until it is decomposed. Roughly 70–75% of that output is a byproduct of copper, lead, zinc, and gold mining. Only about 25–30% comes from primary silver mines. That matters because byproduct supply is inelastic. If silver prices double, a copper miner does not double output. Their production is governed by copper economics. This places a structural ceiling on how quickly silver supply can respond. Now look at demand. Fabrication, electronics, solar, brazing alloys, medical uses has grown to roughly 55–60% of total consumption. Investment demand fluctuates, often in a wide band from 150 to 300+ million ounces per year, depending on macro conditions. Jewelry and silverware add another 150–200 million. Even in conservative estimates, total demand frequently approaches or exceeds total mine supply. The difference is often filled by recycling, which itself depends on price incentives and industrial scrap flows. This means the market regularly operates near balance. A 2–4% change, 20–30 million ounces, can flip surplus to deficit. Now layer in availability. Not all silver exists in a form that can respond to price. A bar locked in a central vault is different from silver embedded in a circuit board. Exchange warehouses report stocks, but those stocks are a subset of global above-ground inventory. Within those warehouses, only registered metal is immediately deliverable. The rest is eligible. It meets standards, but is not for sale. If registered stocks are, for example, 100 million ounces, and total annual industrial demand is 500 million, then the exchange float represents roughly 2 or 3 months of industrial usage. That is not a buffer. It is a fuse. Now compare that with paper claims. Futures open interest can easily imply exposure to 600–900 million ounces. ETFs may hold another 400–500 million ounces. Derivative overlays, options, swaps, structured notes add additional synthetic exposure. The system functions because most of these claims are never exercised for metal. They net against each other. The problem arises when physical deficits coincide with financial positioning. Consider three simplified scenarios, clearly labeled as illustrative. Scenario A, balanced world mine supply, 850 million Oz recycling, 180 million Oz. Total supply, 1.03 billion Oz. Total demand, 1.0 billion Oz. Net surplus, 30 million Oz. In this world, inventories build modestly. Futures curves remain in mild contango. Lease rates stay near 0 to 1%. Price discovery is stable. Scenario B, industrial drift, mine supply, 840 million Aussie, slight decline due to base metal slowdown. Recycling, 170 million Oz. Total supply, 1.01 billion Oz. Industrial demand grows 4% year over year. From 550 to 572 million Oz investment and other demand steady. 430 million Oz. Total demand, 1.02 billion Oz. Here, the margin is gone. Any logistical disruption, shipping delays, refinery outages, geopolitical friction creates a deficit of 10-20 million ounces. That is only 1 to 2% of annual flow, but it can represent 10 to 20% of registered exchange stocks. Scenario C, policy shock. Mine supply, 830 million Oz recycling, 160 million Oz, price suppressed, scrap withheld. Total supply, 990 million Oz. Industrial demand rises to 600 million Oz due to energy infrastructure mandates. Investment demand rises to 300 million Oz during a macro scare. Total demand, 1.05, 1.10 billion Oz. This is a 60, 110 million ounce gap. That is not bridged by sentiment. It is bridged by price or by rationing. Here's the structural problem. Futures prices respond fastest to macro variables, rates, dollar strength, equity volatility, not to warehouse cues. In scenario C, if real yields rise 100 basis points and algorithms sell silver, the paper price may fall even as the physical deficit widens. That suppresses recycling, delays mine capex, and accelerates consumption. The signal is inverted. This is why normal expectations fail. The market assumes that lower prices create surplus. In a dual-use metal with inelastic supply and policy-driven demand, lower prices can create shortage. The data story is not about a single inventory print. It is about the ratio between promised ounces and mobile ounces. When that ratio stretches, the price becomes a lagging indicator. It describes yesterday's liquidity, not today's constraint. When a paper market drifts too far from its physical anchor, the correction rarely arrives as a clean, linear repricing. It arrives as a transmission failure. Spreads widen. Liquidity thins. Correlations break. The price does not simply go up to match scarcity. It begins to behave in ways that confuse observers who expect smooth adjustment. This is because futures markets are designed to clear financial risk, not industrial urgency. The first stage is almost always subtle. Bid-ask spreads widen on near-dated contracts. Market makers quote less size. The depth of book thins. On-screen volume remains high, but the cost of immediacy rises. A trader can still transact, but moving even a modest amount, say 1,000 contracts, equivalent to 5 million ounces, moves the market more than before. At the same time, physical premiums diverge. Retail bars trade $5 per ounce over spot. Large format bars, 1,000-ounce good delivery, begin trading above futures in private deals. Lease rates rise. These are parallel markets sending a different signal than the screen. This is where behavior begins to look irrational. A macro sell-off hits equities. Risk models trigger deleveraging. Silver futures are sold because they sit in risk asset baskets. The futures price drops 3 to 5% in a day. Commentators say silver is weak, but in the same week, industrial buyers are forced to pay above-screen prices to secure metal. The market is simultaneously cheap and scarce. That divergence sets up feedback loops. One loop runs through volatility. As liquidity thins, price swings widen. Options markets reprice. Implied volatility rises. That increases margin requirements. Higher margin forces leveraged longs to reduce exposure. That selling pressure pushes futures lower, even as physical tightness worsens. Another loop runs through basis. The basis is the difference between spot and futures. In stress, the basis becomes unstable. Arbitrageurs who normally buy spot and sell futures, or the reverse, step back because the hedge no longer guarantees delivery. When arbitrage capital withdraws, the two markets decouple further. A third loop runs through inventory behavior. Lower paper prices discourage recycling and scrap flows. Holders of physical metal delay selling. Vault operators see fewer deposits. The physical float shrinks. That increases the leverage embedded in the system. More claims on fewer ounces. This is why the eventual move is often discontinuous. It does not resemble a steady trend, it resembles a gap. Historically, this pattern appears in many commodities under stress. In oil, it shows up as backwardation and time spreads exploding. In natural gas, it appears as regional price spikes disconnected from futures. In base metals, it appears as warehouse queues and canceled warrants. The common feature is that the infrastructure becomes the story. In silver, the infrastructure is delivery. Observers should not only watch the headline price, they should watch the front month versus back month spread. Flattening or inversion is stress. Lease rates. Moves from sub 1% to 5 to 10% signal scarcity of lendable metal. Exchange warehouse classifications. Large shifts from registered to eligible tighten the float. Physical premiums in wholesale markets, not just retail coins. ETF creation notch redemption patterns. Persistent redemptions during physical tightness indicate synthetic supply substituting for metal. When these indicators diverge from futures prices, the market is storing tension. The final transmission typically arrives through one of three channels. Delivery pressure. A higher than normal percentage of contracts stand for delivery. Shorts scramble, near month prices gap. Policy response, exchanges adjust rules, margins, or settlement terms to preserve order. That itself becomes a signal. Industrial repricing, large buyers lock in long-term contracts at prices far above spot, resetting expectations. To an outside observer, this looks chaotic. Prices fall when they should rise, then they jump when nothing new appears to happen. The logic is not emotional, it is structural. The system is attempting to reconcile two clocks that no longer agree. The futures market transmits macro shocks in milliseconds. The physical market transmits scarcity in months. When the gap becomes too wide, the reconciliation is abrupt. This is why a divergence phase is dangerous. It conditions participants to distrust the signal. When the signal finally realigns with reality, it does so violently. Not because silver is special, but because leverage and logistics cannot be reconciled gradually. When a market enters a divergence regime, where paper price and physical reality no longer agree, the future does not unfold as a single path. It branches. The system searches for equilibrium through time, price, or disruption. What follows is not a prediction. It is a structural roadmap. How this class of imbalance typically resolves, what timelines apply, and which indicators confirm each path. Think in three horizons. Next 24 to 72 hours. This window is dominated by paper dynamics. Futures flows respond to macro data, rates, CPI prints, central bank guidance, equity volatility. Silver may move 2 to 5% in either direction with no reference to metal availability. What matters here is behavior, not direction. Does liquidity thin in front-month contracts? Do spreads widen relative to recent norms? Do time spreads flatten despite falling prices? These are early signs that price is losing depth. Next 4 weeks. This is the physical feedback window. Procurement cycles, delivery notices, and lease markets respond. If tightness is real, it appears here. Lease rates drift higher and stay there. Physical premiums stop mean reverting. Warehouse classifications shift toward eligible, shrinking deliverable float. At this stage, the paper market may still deny the signal. That denial is the tension. Next 1 to 3 months. This is where regimes change. Either price realigns or the system introduces friction, rule changes, settlement incentives, or rationing through delay. Markets rarely remain in unresolved divergence beyond a quarter. From these horizons emerge three scenarios. Scenario 1, base case, gradual repricing. In this path, the futures market begins to incorporate physical stress. Time spreads flatten. Near-month contracts lead. Price rises in steps rather than in a single spike. Industrial users pay more, but supply responds at the margin through recycling and inventory release. Confirming indicators, persistent backwardation or near-flat curve, lease rates holding above historical norms, e.g. 3 to 6% versus sub 1%, rising ETF holdings alongside rising price, capital following scarcity, stable or increasing registered stocks despite higher deliveries, volatility, rising moderately, not explosively. This is the least disruptive outcome. The cost is inflationary pressure across downstream goods. Scenario 2, stress case, fracture and gap. Here, paper markets continue to suppress price while physical deficits grow. Then a trigger, delivery concentration, policy shift, or macro shock forces rapid adjustment, liquidity vanishes, prices gap, settlement rules become headlines, confirming indicators, sharp drawdowns in registered stocks during delivery windows, lease rates spiking into double digits, large physical deals clearing well above futures, sudden increases in margin requirements. Intraday moves exceeding 5 to 8% without news. This path is disorderly. The system chooses repricing over continuity. Output is preserved, but financial positions are revalued violently. Scenario 3. Relief case. Structural ease. In this path, one of the constraints loosens. It could be a slowdown in industrial demand, a surge in recycling, or policy-driven supply release. The physical market relaxes before stress propagates. Confirming indicators. Lease rates falling back toward historical lows. Rising warehouse inflows. Physical premiums compressing futures curve, returning to contango, industrial buyers extending contract horizons. This is stabilization through abundance. It requires a real change in flow, not narrative. Across all scenarios, the lesson is the same. In dual-use commodities, market structure matters more than headlines. The futures price is not wrong. It is incomplete. It reflects the behavior of the most liquid participants, not the constraints of the slowest ones. When financial systems price goods that must move through ports, refineries, and factories, time becomes a risk factor. The paper market trades in seconds. The real economy clears in months. Divergence is the space between those clocks.